Hello class, here is another video for the simulation ledger. This one's going to go through a little bit of the more advanced or trickier ledger entries. So we'll kind of pick up where we left off in our ledger basics video. We had bought some gold, all right, and $5,000 of gold to be exact. So when we submitted our construction that month for two agriculture auto factories, totaling in $50,000. On that same form, we would have entered buying $5,000 of gold. So at the end of your construction form, every time you submit it, there is a section for buying or selling gold. All right, if you sell, that would be gold withdrawn, but you can't do that if you don't have any. And if you are buying any gold, that's going to be input here. All right, and we saw that as soon as we entered to $5,000 in this case, they calculated how much appreciation or interest we would earn that next month. So we're not going to see that $250 until February. All right, but we can still record this in our ledger, and here's how we're going to do that. So right after we buy this gold, we're going to go and enter it from cash. So we credit the cash and we debit the gold. We now have this extra gold. And I'm going to actually add a couple rows here. So I'm going to right click and insert a row above so that I can show you how to properly account for that interest or that gold appreciation for the next month. All right, and it's a little bit of a confusing transaction the first time you go through it, but again, once you get through it in January, you can kind of just copy and paste for the rest. So we're still in January, backtracking a bit, and we are still getting our gold. And you could use the same code, gold for 01 for January, or you could differentiate it a little bit, and I think that's what I would prefer to do here. Totally up to you. There's no right or wrong way to do it, but I'm actually going to leave myself a second category that's going to handle all of my gold appreciation and my interest. So I'm going to call this gold appreciation, and it's happening in January. So this is the category that I'm just creating right now to account for my gold appreciation. So we need to have this $250 accounted for. But what is that $250? Well, this is actually going to be some future revenue. All right. So it's actually going to go into an accounts receivable, starting with number 4. All right. We only have 2 of them. We're going to call this our accounts receivable. And I know that in February, my gold is going to gain this interest. So it's going to debit. All right. And if you're feeling a little bit confused about the debits and credits still, since that is an account starting with a 4, which is an asset, I'm increasing how much future assets I'm going to have, and that increase of an asset, or a future asset in this case, is a debit of $250. All right, we need a matching credit. I know that needs to be 250, but what do I call it now? And why is it not balanced? Because I don't have a category yet. So this is going to be not my future gold that I'm getting. This is actually my equity. So I'm actually going to be gaining this much in equity or retained earnings. My account starting with number 3, retained earnings. So as soon as I knew how much money my gold was going to appreciate at, how much interest I was going to gain, I entered that into a future account. It's not a current asset because as indicated on this summary sheet, that's gold appreciation or gold interest for the next month. All right. But it's a future asset that I need to track with my accounts receivable, starting with number 4 for a future asset. And we balance it with our net worth, 250. All right, and that's it for January's gold. So I'm going to now fast forward a little bit because we've got two kind of interesting categories that are going to affect this accounts receivable. We have our construction from January. And if I was smart, I probably would have put a note here telling me that this is going to be 2 auto eggs and they're going to be complete in July. All right, so I need to remember in July to transfer this $50,000 out of my accounts receivable into the actual completed auto factories now. All right, so I like to make a note about that so we don't forget about it in July. All right, and another thing that I want to note, or you don't necessarily need to make a note about this, but something that's going to happen, not quite as long term away, not quite as far away, but still important, is to remember our gold that's now going to be appreciated. And when that gold appreciates next month, it's going to come out of this accounts receivable and turn into gold. So your gold investment is going to kind of keep building up, and any interest you make on the gold isn't going to be stored as cash for you. It's going to be stored as more gold, and you'll see that compounding interest effect here. So you keep reinvesting your gold appreciation back into gold, and therefore you have more of this gold principal, this gold fund earning you more and more interest each month. And that's what we would call compounding interest. All right, so I'm going to start with the shorter term transaction. Now, in February, I know that I need my gold to come out of an accounts receivable where it's a future revenue. Now it's actually a future asset, I should say, rather. Now it's an actual asset in February. So let's scroll down to February. You'll have to fill in all these numbers, unfortunately. But now I get here. And I'm going to, for February, well, I got two options. Maybe in February I decided that I was going to buy more gold, right? So I could go into my summary sheet and say, okay, in February, I actually bought now $10,000 of gold, right? Or $1,000. Or let's say you actually don't, because that's an option too. Maybe you didn't buy more gold. So maybe you leave this one empty and blank, but then you go and you get your gold appreciation. And this gold appreciation will need to be included in every month that you have some gold that's gaining interest. Even if you aren't investing new gold, like I hypothetically didn't invest in February, on February's ledger, I still actually want to track this gold appreciation. All right. Sorry, this isn't 01. We're now in 02. And that would unfortunately mean you'd have to go and change all of these numbers to 2 all the way up. All right. So my gold appreciation now is going to go from this future asset, this accounts receivable, and it's going to leave the account receivable. So I'm losing that potential future asset and gaining an actual asset, the gold. So that means I need to credit my accounts receivable. And this is from the previous month. So you can make a note that this is the appreciation from January. And I could go back up and double check how much that actually was. It was $250. All right, so I'm going to credit that $250 from my accounts receivable. And that's now turning into gold, my investment. Now I have an additional $250 in my gold, and I can double check that in the top right here under my gold investment. Now I have $5,250 stored up in gold, which now actually means that I need to further appreciate. All right. You'll see this happens. You'll have this gold appreciation of full 4 lines after that first month, because you're going to turn that amount from the previous month into gold, and that's going to give you your remaining gold number in your charter of accounts. And this now I need to record as my future revenue, my future asset is accounts receivable that will in March turn into gold. So this is my new accounts receivable. So I'll still call this gold appreciation, but now I'm not tracking what was going on in the last month. Now I'm doing what new interest am I gaining this month? All right, so I'm going to fill up my accounts receivable again, and this time it's going to be $262.50. $162.50. All right, and how do I balance that? Well, that's interest that I'm gaining. It's increasing my net worth. That's my retained earnings going up, and retained earnings or equity goes up as a credit. So we'll increase that by $262.50. All right, and I can make a little note here. This is going to be my appreciation for February that I will then need to withdraw from the accounts receivable in March and turn into gold, right? And then I'll have a new appreciation for March, all right? So if you have a bunch more, just want to see me do the example of that in March, I'm going to have my gold appreciate again. And whether or not you bought more gold, you're going to have to enter this. And it's going to be 4 lines. We're going to take the gold out of my accounts receivable. So we're going to credit the accounts receivable. And last month it was $262.50. See that up here. 262.5. And we're going to turn that into our actual gold. Same amount to balance it. And now I have new interest that I earned, and my ledger does the calculation for me. So I get 270, what was it, 3.5? 275.63. I don't like that number, so I'm going to copy it. Control C, and I'm going to right click, paste this as a value. All right, so that is my new future appreciation account receivable, debiting it so it goes up, and my retained earnings also increases. So I credit that by that same amount. All right, that is your gold appreciation ledger entry. All right, we had one more thing to cover. That was our construction, which I made a nice note of in January, and the months go by, and now let's say all of a sudden we are in July. All right, and I would say best practice is to actually do this before you even pay your fixed expenses in July. This is going to be, maybe I'll use the same sort of category, the same CCID. I called it my construction. All right, so I'm going to do my construction now for July. This is the ribbon cutting ceremony of my factory. All right, it's going to be opened up, and I'm going to do this before, what month is July? 06? No, 07. I'm going to do this before my fixed expenses because I'll actually have to pay fixed expenses for this. or these two factories here. So I'm going to pull out of my accounts receivable the $50,000 that I had put in there for my construction of my two auto agriculture factories. All right, that $50,000 is no longer in this future asset because the construction's done and it is now an actual complete auto factory for agriculture. And it's two of them. So I got $50,000 in these new shiny auto factories of the agriculture variety. All right, that's all it really means. You can make a note that the construction is complete. All right, and we've recorded it, and now it's gone out of my accounts receivable. This account starting with 4 right here. So I only have a little bit left in there from my gold. Right, you could have numbers there from gold, from future constructions that are waiting to be complete. All right, but now I also have these new auto agriculture factories, this new asset up to $50,000. All right, that would be it. And then I would continue along with July and I would pay my fixed expenses. And that would have to change now. I need to go into my summary sheet and figure out my fixed expenses based on my new factories from the price info sheet. All right, you would find in July that you got your same two standard factories if you did no more construction. All right, so 2 of each would have been $9,000 again. Then our auto factories, I need to pay my 3,000 times 2. So I have 2 of these, $3,000 times 2 factories is 600, and I have my regular basic warehouse. And if I didn't get any more upgrades, I just go through here, and maybe I've got no leftovers. And I would just take the sum of these numbers above it, and those are my new fixed expenses for July. Seems low. 15,000, 9,000. All right. I guess it is that low. No. Let's see what numbers I'm adding together. Was one of those just 900? No, that's way too big. Maybe these all have to be dollars. That's not $100,000. That's just 10,000. There we go. $26,000. Pay my new fixed expenses. Remember that every time your construction completes, right, you need to change fixed expense for your new construction. All right, so now pay my cost of goods for my fixed expense. All right, and it's now up to 26,500. And that comes out of my accumulated losses. And then I pay the liability because every time, oops, too many zeros. Every time I get a bill, I immediately pay the bill. So my cash goes down, back and forth, debit, credit, the cycle goes on. All right, that sums up our gold and our construction, two of the, I would say, harder ledger entries, but hopefully this helps you figure those out. One last thing, that you got to remember to do in December is your taxes. All right, and there is a specific category for your year-end taxes. You'll have to do your whole profit and loss statement to figure out exactly how much you owe. All right, and then you pay your taxes by getting the bill. So maybe this year I had to pay $123,456, and I take that as a loss. This is money that I have to pay to the government. It's a bill that's going to cost me some equity, some net worth. Then I get rid of my cash just like I would for any bill. I pay it. And as a result, the bill, my taxes, goes away. It is debited. And voila, taxes at the end of December, or technically start of January if you entered it there. That'd probably be even better. Let's call this January. Before we do anything else, our fixed expenses in January, we would do our taxes. If this is just a 12-month simulation, you could go ahead and call that December. All right, that's all I got for you. Hopefully this helps you out and gives you some of that information on construction, taxes, and gold that you may have been a little bit unsure about. All right, take care. I hope you enjoyed the videos.